I'll have to be honest with you. First thing I'm going to mention right up front is it's free. I like this service when it's free because, you know, you can tie up a lot of money in different services, and from experience I found out that sometimes you can pay a lot of money and you may not be getting that much out of it.
Good afternoon, welcome to GrainTV. It's May 21st, 2014. I'm Logan Burgess. To my right here is Cody Bills to help break down a mixed trade in Chicago for the grains. Jumping into the quotes here, we had corn up a penny. Soybeans on the July contract up 35.5 cents. Last trade here, 15.05 and a quarter. We saw Chicago wheat down 6 1/4. Cody, once again, soybeans, the highlight of this trade. A lot of volatility, a lot of back and forth action. Break down what we saw here today.
Yeah, we talk about the volatility, and really in the last couple weeks, it seems like we've seen relative strength or relative weakness out of the soybean complex. To me, that's just showing an environment where volatility is increasing. You know, yesterday we had a situation where we tried to break out, we failed, we closed near the lows of the day. We talked about this in the morning commentary, where that sort of price action is typically a warning that the trend is about to change.
Right.
Now, we also warned that in an environment of highly volatile price action, you know, you can get that sort of price action, and we may not necessarily, it may not be as potent of an indicator as it has been. It seems like that's the case today. We rallied back up sharply. We're now over the highs that we printed in late April.
Yeah, Cody, you know, taking a look at this, for traders out there, both speculators and hedgers looking to price some of the new crop here, what are some strategies, what are some things to keep in mind when looking at soybeans in particular because of that volatility that we're seeing?
I think the biggest takeaway here is that if you're a speculator, when you have a situation where volatility is increasing and the predictability of price action is also diminishing, you don't want to get in a situation where you're backwards in the market, you're in a losing trade, and you double down to dollar cost average and get yourself in a better dollar cost average. What that does is it exposes you much greater to that price action. And in an environment where price action is chopping around, you want to be able to weather the storm. You want to be able actually to even kind of shrink your exposure to that market so you can handle wider swings, especially if you're in a losing trade. So I guess the biggest takeaway is don't double down. What happens when you do that is a large price action like today could end up blowing you out of a trade that otherwise may work in your favor down the line.
You know, it's been a really different story for the corn market in recent trade sessions, Cody. That volatility that you referenced in soybeans really hasn't been there in corn that much, and it's been a relatively quiet fundamental landscape as well. We got the ethanol numbers out today, just 3,000 barrels per day higher on the week, so not a huge story there. We talked about it yesterday. The Chinese, there are some rumors that the Chinese may be canceling outstanding old crop export sales, but at the moment that doesn't seem to really be weighing on things either. This market's kind of looking for direction. If you take a look here at the July 14 corn chart, this is a daily chart here. This is a candlestick chart, so each candle that we see here is 1 day's worth of price action. I think it's important to take a look at the technical landscape right now. On this chart here, what we have is a Fibonacci retracement drawn. It's drawn from the lows starting in January to the very highs that we had in late or early March here, and as you can see, the blue line here going across is the 50% retracement. So basically the middle line there between the lows and the highs that we've seen in this recent move. And as you can see here recently, this has acted as support to this trade. A lot of technical traders look for Fibonacci retracements to either support a falling market or to limit a market that's been moving higher. That looks to be the case here for the corn market. So right now, if I was looking at the old crop, I'd be a little bit hesitant in getting short this thing until we can see a stronger move lower. This is an area that should act as technical support, and considering the old crop stock situation, I would think that the fundamentals right now are in alignment for this market to move sideways, maybe see a little bit of a rebound off this. That's something I'll be watching tomorrow in the trade action.
That sounds fair. Now, basically, what you're saying is we could see a little bit of a price rebound from this support on the 50-day?
Yeah, absolutely. When you see markets like this move lower, as I said, technical traders look for a 50% retracement of a large move like this to act as support. One big thing that's going to be driving the trade in tomorrow's action is the export sales report. Relatively large old crop corn sales expected, 325,000 to 525,000 metric tons expected there. We've seen relatively light corn sales over the last couple weeks, so we'll see if that can support this July contract at all in tomorrow's action. But as I said, keep an eye on this here, and we have a great trading platform available here at Grain Hedge that lets you view live quotes and draw Fibonacci retracements, the trend lines, really anything that we use here on GrainTV. You can draw that in your own home or office. And if you have questions about that, give us a call at the office, 877-472-4607. Thanks a lot for joining us here on a Wednesday. We'll see you tomorrow for the export sales report.